Good afternoon. Last year saw the greatest decline in gold prices in 32 years, and my book, $10,000 Gold, was published. How's that for timing? However, I'm confident that the gold drivers that were set out in my book are still very much intact. Last year, COMEX Futures Exchange distorted gold prices and provided investors with the second greatest opportunities to buy gold since 2002. On April 12th, the gold price declined by $150, and on June 20th by $80 because of naked short selling of futures contracts. These precipitous drops triggered sell stops and margin calls, and the Western media jumped in to declare that the bull market in gold was over. In sharp contrast to the falling price of paper gold, the demand for physical gold soared. The U.S. Mint and the Canadian Mint both ran out of stock. Many retail coin stores ran out of stock, and premiums rose by as much as 20% for gold and 40% for silver. The lower price also represents a problem for miners, because average mine production costs now exceed $1,200 an ounce. Many high-cost producers will be forced to shut down, causing supply and demand pressures. Clearly, the physical price of gold cannot decline much further for any length of time, and this correction is close to an end. In addition, the days of COMEX dominance of the gold price are numbered, since the monthly deliveries on the Shanghai Exchange already surpass global mine supply. However, the main driver of the gold price is, and always has been, increasing money supply. An increase in the money supply is the very definition of inflation, as it devalues currencies and destroys purchasing power. If an increasing money supply led to prosperity, Zimbabwe would be the richest country in the world. This chart shows that gold and the U.S. government debt have shared a lockstep relationship since 2001. Despite the divergence in 2013, over the longer term, the U.S. debt and gold should return to equilibrium. Since the official public debt in the U.S. is $17.3 trillion today, in order to bring the debt-to-gold relationship back to equilibrium, gold should now be $1,800 an ounce. Since there is no political will to curtail either debt or introduce austerity measures, I believe gold will surpass $1,800 and likely set new highs in 2014. It is not just the U.S. that has this debt problem. Ever since President Nixon closed the gold window in 1971, the world has been in a global fiat currency experiment where every dollar in existence has been created through the issuance of new debt. Without the stability of gold backing, this has encouraged unbridled currency creation and reckless credit expansion at an exponentially increasing rate, taking fewer and fewer years to double. Since President Obama took office in 2008, the U.S. cash debt has increased from about $10 trillion to over $17 trillion. This figure doesn't take into consideration the very real $127 trillion of unfunded liabilities, such as Medicare, prescription drug plan, and Social Security. For this, taxpayers will ultimately be responsible, and this works out to about $1.1 million for each U.S. taxpayer. The debt buildup is not limited to the U.S., but includes most Western economies. The systemic risks that caused the financial meltdown in 2008 have gotten worse. The world's financial system was almost destroyed, in part because of $1.2 trillion in mortgage derivatives. Today, interest rate derivatives alone are 450 times higher at $561 trillion, or 7 times global GDP. What could possibly go wrong? Long-term treasuries ended 2013 pushing 3% and will likely rise if the Fed's tapering measures increase. In the U.S., a 1% rise in interest rates translates into an additional $170 billion of annual interest costs and increases both the debt and the deficit. All other Western countries face similar situations. Interest rates at 3% in Japan will consume all of the country's tax revenues just to service the interest payments. The bigger problem will, however, be declined in bond portfolios if interest rates rise. In Europe, most banks hold significant amounts of sovereign debt as part of their capital. As interest rates increase, the value of their holdings will decrease incrementally. And due to the high leverage ratios, some banks may need either bailouts or bail-ins to shore up their capital ratios. And those same banks may find that their interest rate derivatives have unexpected counterparty risks. The debilitating effort of the growing debt is clearly illustrated by the next chart. It shows that in the 50s, for every dollar of increased debt, the economy grew by $4. In 2013, for every dollar of debt increase, the economy only grew by 50 cents. And during the last decade, if you were to use real GDP rather than nominal GDP, the real GDP only increased at an average of 8 cents for every additional dollar of debt. You don't need to be a mathematician to understand that this trend is not a recovery and is unsustainable over the long term. Now, while demand for gold in the West dropped to an all-time low in 2013, the unprecedented demand for physical gold from Eastern buyers confirms that Eastern nations will no longer tolerate the debasement of their U.S. Treasury holdings. China bought a record 2,200 tons of gold last year. This is close to total global mine production. Many informed gold watchers feel this is a conservative figure, and the true figure will remain a mystery until China chooses to disclose it, likely in 2015. China is the world's largest gold producer and not only buys all of its own domestic production, but also buys, through their opaque sovereign wealth funds, the remaining balance, and then at some point in time transfer it to the central banks. In 2009, China announced its gold reserves at 1,054 ounces. It would not be surprising to see that China owns over 5,000 tons by 2015. If we add the purchases of the other Far Eastern, Middle Eastern, and Central Asian countries like Russia, far more physical gold was purchased than was mined. Now, the movement away from the U.S. dollar is intensifying. China has now signed over 25 trade agreements that circumvent the U.S. dollar, in which they settle trade imbalances with the participants' own currencies. This will continue to place downward pressure on the demand for dollars, and if the dollar loses its reserve currency status, America's ability to print unlimited amounts of money without consequences will be over. This chart shows the lifespan of the 5 previous reserve currencies that preceded the U.S. dollar. The average is 94 years. Gold's lifespan as stable money is 3,000 years and counting. If we take the demise of the British pound as the world's last reserve currency in 1920 as the starting point, 2014 will mark the 94th year of the U.S. dollar's lifespan. During this time, it has lost 97% of its purchasing power. I firmly believe we're in the late stages of the U.S. dollar's reign as the world's reserve currency. Considering the strengthening fundamentals we witnessed for gold in 2013, despite its poor price performance, it appears that an opportunity similar to that of 1976 is a strong possibility. Gold rose 450% from 1971 to 1974. It then retreated 43% over the next 18 months. Many investors lost confidence and sold their gold holdings, vowing never to invest in gold again. The New York Times proclaimed the end of the bull market. However, during the next 4 years, gold climbed 750%. A similar percentage increase from today's price would see gold trading at $10,000 an ounce. While there may still be price declines, I feel today's situation is similar to that of the 1970s, and we have the second greatest opportunity to buy gold since 2002. Today, many investors are tempted to sell their underperforming precious metals holdings and use the proceeds to purchase U.S. securities. But there's an old Wall Street saying, buy low, sell high, not sell low, buy high. While no one knows with absolute certainty the exact time frame for these developing events, the most conservative route for portfolio protection is diversification with at least a 10% allocation to gold. Gold is the most negatively correlated asset to financial assets and acts like portfolio insurance in a decline or a crisis. For true portfolio protection, however, you need physical gold, to which you hold clear title, and the bullion is stored in allocated storage or your own vault. It is critical that your bullion holdings have no counterparty risk and are not proxies or derivatives, such as gold certificates, futures contracts, or ETFs. Thank you, and all the best in 2014.